Cost volume profit. Cost volume profit is really an analysis tool that we can look at so that we can really analyze what's happening, analyze what we need to do to get to certain points in really decision making. It just really helps us be decision makers. We've really moved out of some of those basic journal entries into now looking at, if we are a manager, how do we make decisions for our company. And so that's really what we start looking at with this cost volume profit analysis. With cost volume profit, we really have to be able to look at cost, and our costs are actually divided into several categories. The first one is variable cost. Now, variable costs are costs that vary in total, directly and proportionately with changes in activity levels. So what this is saying is, if I produce more units, then my total cost will be more, because the actual cost is going to stay the same per unit. So here, for variable cost, it may be, $10 per unit. So the per unit cost does not change, but, if I produce 100 units, then I'm at $1,000. If I produce 200 units, then it goes up to $2,000. And so with a variable cost, it is in direct proportion, direct relation with what is happening. Now, for a fixed costs are items that the total cost stays the same. So this would be like rent. Our rent, if it's $10,000 a month, it doesn't matter if we produce one item or we produce 10,000 items. Our rent is still going to be $10,000 a month. So it is not going to change. It will stay the same. But now per unit, if we produce more, then per unit would go down because it is staying the same in total amounts. When we look at mixed cost is going to have components that are variable, and it will have components that are fixed. So what we have to look at here, if we go back, I know it just really depends on who you rent a car from, but if you were to try to do something like rent a car, there is a certain fee that you are charged per day. That is your fixed cost. Then your variable cost, if you go over their mileage allocation that they will allow you to have, you will pay a variable cost per mile. So it has some components that are fixed, it has some components that are variable, and we really have to look at it and break that down into the cost, because we need it listed as a variable or as a fixed cost. Other items that we have to deal with in this chapter is the relevant range, because if we only produce, let's say, 10,000 units, so 0 to 10,000 may cost us $20,000. And then if we move up, we may have to purchase a new machine. And so if we go 10,000 to 20,000 units, it may cost us $40,000. If we then produce 20,000 units to 30,000 units, it may go up again, and we may have to pay $60,000. So in doing this, we really do have to look at what range are we producing in, and that can matter. When looking at when we look at that mixed cost, there are different ways that we can figure out the differences between variable cost and fixed cost. One of the methods, and this is the method we are going to use in Accounting 102, is going to be this high-low method. It's one of the easier methods to use, and that is the method that we're going to be using for this class. And it just looks at the highest level of output, the lowest level of output, what are the costs, and coming up with the changes. And we'll go in more detail with this when we look at our worksheets. You also can use scatter plots or regression analysis, or two other things. We are not going to do either one of those in this class. That is something that can be done in a different class, a more advanced class. You may see those types of items out there. Now, with cost volume profit analysis, there are some assumptions that we have to follow. The first one is that the behavior of our cost and our revenues has to be linear. In other words, it has to be that straight line throughout a relevant range. The second thing is that our costs have to be classified as either variable or fixed. The third thing is that if we have a change in activity, that's the only thing that is going to affect our changes in cost. All units produced have to be sold. And if we're selling more than one product, we have to realize that that sales mix has to remain constant. If these items are not there, then we cannot use this CVP analysis, because the CVP analysis then could be inaccurate with making decisions. So we have to have these items in effect in order to use CVP analysis. Now, the CVP income statement is a little bit different than what you've seen before with your income statements. Up to this point, we've had our sales minus our cost of goods sold gives us our gross profit, and then we look at our operating expenses, and we get our net income. That is not the way we look at a CVP income statement. With CVP, we will have our sales, but then we will have variable cost. Now, variable cost could be part of that cost of goods sold. They could be part of our operating expenses. We then would find our contribution margin, and then from there we would take out our fixed cost, and then we would have our net income. So this is the one that you want to use when you are looking at CVP income statements. Some of the equations that you have to know for this chapter, you have to know that the contribution margin is going to be the selling price minus that variable cost. The contribution margin percentage is going to be that unit cost, or that unit contribution margin divided by the unit selling price. So those are two of the equations that you will be looking at. Other things in equation-wise for this chapter, we're looking at the basic equation that states that our sales minus our variable cost minus our fixed cost equals our net income. And then we have to realize that we want to look at some break-even analysis. And what does break-even actually mean? Well, break-even is when our net income is zero. We don't have a profit. We don't have a loss. We break even. In other words, our sales are going to be equal to our cost, is what that break-even point is. Now, the equations that we will use in break-even analysis, if we want to figure out what our break-even units are, we will take our fixed cost and divide that by our contribution margin. If we want our break-even in sales dollars, we can do it two ways. If we already know our break-even in units, we can use that amount and multiply it by our sales price. Or we can take our fixed cost and divide it by that contribution margin ratio. So it really depends there. If you already have your break-even in units, the easiest way to do it is just multiply it by sales. If you don't, then you can take the fixed cost divided by contribution margin ratio. Other equations that we're going to look at, we don't always just want to know what point we're going to break even at. Sometimes we might want to know and say, okay, we want a profit of $20,000. So if we want a profit of $20,000, we may need to know how many units we need to produce to do that. And so that profit amount is going to be our target income amount. So with that, you would take your fixed cost, you would add what you want your income to be, so what you want your profit to be, and then divide that by the contribution margin, and that lets you know how many units you have to sell to make that profit. And then one of the other items that we look at is this margin of safety. Now, with the margin of safety. This is going to be the difference between what we actually or expect to sell and what our break-even point is. This lets us know what our cushion is for a particular level of sales. So we can do a margin of safety in dollars, we can do a margin of safety in units, and then we actually can find a margin of safety ratio as well. But it really just lets us know how much give do we have before we get into trouble. How much give do we have before we're going to start losing money is really what that margin of safety is going to, look at. Again, these different things that we're looking at with the CVP analysis, whether it's break-even point, whether it's a target income, it could be, do I offer a discount? Do I invest in a new piece of equipment? All of these pieces of information can be answered using the CVP analysis. So when we get into decision making at the end of the textbook, you might have to look at some of this CVP analysis to decide what you should do for different items. So you do want to make sure that you understand the information, because it is very important when you are trying to make decisions in a business. When you get into doing something like a marketing plan, when you are doing a business plan, this CVP analysis is very important for you to figure out what point you have to be at to make money, where you need to be before you decide. This is information that the bank's going to want to know before they loan you any money. You're going to have all of these calculations done before you do any of that. So when you're looking at a marketing plan, when you're looking at a business plan, CVP analysis is very, very important. It's very important as a manager. It's very important as someone who wants to start their own business. CVP analysis it is vital that you understand this information. This goes hand in hand, as I said, with marketing and with management. So it's very important that you understand this information. Even though it's numbers, even though it's accounting, it is going to open doors for you if you understand this material in that marketing world, in that management world.